Okay, in this video I'm gonna tell you everything that I know about the only strategy that I know where you can get paid to buy real estate. And a lot of people name it many different ways. Many people know it as the Morby Method, stack method, seller carryback, reverse financing. I don't care how you call it. That is just a process of buying something. And yeah, you can buy anything using this strategy and get paid. So let's get right into it. In this video, I'm gonna be calling it the Morby Method. That's how most people, and that's how I learned it. So let's get right into it. So let me do this and this. I have my iPad, I have a whiteboard. So what is the Morby Method? The Morby Method is a way in this situation to buy real estate. The same way as it's a creative way to buy real estate. You know, we have the conventional way, cash, we have seller finance, we have subject to, we have novations, all of that stuff. And then another way is the Morby Method, okay? Now, what happens on the Morby Method? What happens is that the investor, the buyer, combines a DSCR loan. The seller needs to be open to seller finance, willing to carry some of their equity. And so we combine a DSCR loan, they get a brand new loan, and they combine it with seller finance. So what is the Morby Method? You combine a DSCR loan with seller finance, okay? The next thing that I want to talk about is when can you use it? With anything, okay? But ideal scenario, I'm gonna get into that. When I say anything is, again, this is just a process of buying something. The same way with when you buy subject to, you can buy cars with the Morby Method, you can buy properties, you can buy anything, okay? It's just a process of buying something. Now, when it comes to real estate, and you want to do the Morby Method, there is also an ideal scenario, or like properties that you want to go after, or filters that you want to use, or other way to call it, like a seller situation, right? That you want to go after. So let's get right into it. Free and clear properties. This is an awesome opportunity when the house is free and clear. You can give the seller the price that they want and the down payment that they want and a portion of seller finance. And I'm gonna get into something that is called cashback, and that means on free and clear properties, the buyer can get a high amount of cashback. And of course, it's gonna depend on the down payment that you negotiate with the seller and your LTV. I'm gonna get into that. But free and clear properties, turnkey properties, in these situations, you don't want to go after properties that need a ton of renovation, okay? So ready to rent, that's ideal. Long-term exit strategy. Normally this strategy is used to keep the property long-term. 7 years, 10 years, more than that. Okay, you can still do it from the fix and flips. It's pretty rare because I'm gonna get into that also, but buying on the Morby Method, you're going to be over leveraged, okay? And so it's not ideal unless you buy it pretty low, that is gonna work as a fix and flip. But normally it's for you to buy it long term and keep it long term, okay? Now, you will never know if the property is free and clear until you have a conversation either with the seller or the agent. So this strategy can still work if the property still has from 50 to 60% in equity. Okay? Now, really important, depending on their equity, okay, that is also gonna dictate the amount of down payment that you can give to the seller. For example, if it's free and clear, you can offer a high down payment to seller. If they have a mortgage, that's where you need to offer less to the seller. Almost at the end of the video, I'm gonna go over a deal breakdown, so no worries if it's not making sense right now. But really, I'm gonna go over the 2 rules to see if it works as a Morby Method. Okay, so 2 crucial rules to see if you have a deal. Number 1, LTV, known as the loan to value. Normally investors, when they get a DSCR loan, they get from 70 to 75% LTV. Experienced investors, or depending on the performance of the property, they might be able to get a higher LTV, but I like to run numbers and I suggest You as the buyer, or if you're wholesaling these deals, you run the numbers with LTV at 70%. Okay? So, mortgage balance, the LTV needs to be higher than mortgage balance, cash to seller, plus closing cost, plus fees. If that money needed, I'm gonna call that money needed, goes above the LTV, there is no deal to satisfy the first leg of the transaction. I'm gonna get into the legs. There are two transactions happening on the Morby method. But that's rule number one. Rule number two, that is to check really fast if there is any cashback at closing. Meaning if the buyer gets paid at closing, and that is seller finance needs to be higher, seller finance portion based on the equity. This is also to check if there is enough equity on the property. Seller finance needs to be higher than DSCR down payment, which let's say 30%, if the LTV is 70%, the remaining 30%, plus closing cost, plus transactional lender's fee. Normally, when the buyer does the Morby method, they use a transactional lender to bring the down payment and closing cost. I'm gonna also get into that, so no worries. So, two crucial rules. It's gonna make more sense when I do the deal breakdown, okay? Now, this is something that I get a lot. I work with investors, I work with wholesalers, agents, TCs, all of that stuff, with everyone. And one of the most common questions is, hey, like, I want to work these deals, I want to go after these opportunities. How do I navigate the conversation with sellers? So I'm going to tell you just like a way that I would do it. Everyone is going to have their own way to navigate the conversation, but this is how I would do it, okay? Now, I would always start with a cash offer. Normally, people buying on the Morby method, they are experienced investors. They are going to be investors, not homestead buyers. And the first thing is like to show, hey, if I come in at the full asking price and and give you a cash offer, right? This would be my offer. Most of the time it's gonna be low, and especially it's gonna be offend an agent or seller if it's like a turnkey property, like in good condition and all of that. So, but they need to understand where would you need to be at if you're an investor. The second thing that I would offer is, and this is really important, make sure that before you go into having a conversation about what is called creative finance, seller finance, subject to, hybrid, which is combining seller finance and subject to, you ask them about the mortgage balance. Why? Because it affects everything. You need to know how much equity this property has so you can make a decision on if it's a seller finance, meaning free and clear, subject to, maybe they don't have any equity on the property, they are underwater, so you might just do subject to, or hybrid if they owe like 40-50% of mortgage and then you seller finance the remaining equity. Okay, so you bring your offer as the buyer, and if that still is not working, now you can offer the Morby method, okay, which normally is, you can still give a low down payment to seller and still do the Morby method, but it's going to depend on you and how you negotiate the seller finance. Maybe the seller wants a higher down payment and you are not able to do seller finance only, giving that down payment, so that's when the Morby method comes in, okay? So the Morby method is used when the seller is already open to seller finance, but they either want a high down payment or they are asking for terms that don't work for you as the buyer, okay? As far as down payment and monthly payments on the seller finance, length of time, all of that stuff. So let's talk about something really important, that is working with the right lender for the Morby method. So again, as the buyer, you're gonna need to bring a brand new DSCR loan to the table, okay? So a couple of things. Not every lender is going to work for the Morby method. So you're gonna make sure three things actually, as far as their lending requirements, okay? So number one is sourcing, meaning where does the money come from? That's what sourcing means, the sourcing requirements. So some lenders want to see, hey, for example, if you use a transactional lender, are they okay with that? Does it need to be from your own money? Okay? Seasoning requirements, that means how long does the money that you have in that bank account, okay, for example, LLC or your bank account, needs to be there before you get that loan. Okay, there are gonna be lenders that ask for 6 months, 3 months before you get the loan. Okay, so not ideal. So, and another thing is that the DSCR lender, normally this happens with residential properties. A lot of lenders are okay with second position. Now, when you go into bigger properties, it's more rare to find lenders that are okay with second position. Now, I'm gonna get into the ways you can overcome this if the lender or seller doesn't want to be in second position. But really important, okay? So, yeah, so the ideal lender would be, they are okay, they don't care where the money comes from, meaning sourcing. Seasoning, they don't care if you got a transfer yesterday, now you want to buy the property, so they don't care how long does the money need to be in your account, again. And they are okay with second position. Now, this is where overcoming the second position comes in, and that is setting the expectations with seller. It's really important that you explain that, remember, you get a DSCR loan that is going to be in first position, and then the seller finance is going to be in second position. So you're going to mention, hey seller, I'm trying to get into these deals with little to no money out of my pocket. I'm going to get a DSCR loan to give you what you want, okay? But the seller finance is going to be in second position. Are you okay with that? Yes, no, blah, blah, blah. How does it work? What do you mean? All of that stuff. And then also, even if the seller is open to being in second position, maybe the lender is not okay. Okay, so you need to set the expectation to the seller to say, in case the lender is not okay with second position, we might come up with a way to satisfy the lending requirements, the lender requirements. And we might create an LLC, a trust, many other ways we can overcome that. And that is doing an LLC, for example, the seller is going to be on the LLC with the investor as a capital contribution partner and all of that stuff. That is something that I can help, by the way, but that is a way to overcome the second position. Okay? Now I want to get into how it works. How does the Morby method work mechanically? Okay, well, like the money flow, what really happens. So again, remember, two transactions happening on the Morby method. We have the cash transaction. Okay, it's just, you're gonna need a purchase and sale agreement, cash contract. We satisfy the lender, we bring the money to the table. For example, if you use a transactional lender, that's something that I do. I will bring the down payment plus closing cost, we show it to the lender, they are happy, cash transaction closed. And then what technically happens is that you wait a couple of days, 2-4 days, whatever it's needed. Everything is recorded, the title company records everything, but that's why I put a line in here, as you can see. It says escrow holdback. This means that whatever money the title company receives, the down payment, the loan amount, everything, is saying, hey title company, from all the money that you're receiving, don't send it to the seller, to the buyer, to the transactional lender yet. We wait a couple of days for everything to be recorded, because now we do, and we record the seller finance note. So this is where everybody gets paid. The buyer gets their cash back, okay? The seller gets the money that they were supposed to get as a down payment, and the transactional lender gets the down payment plus closing cost back plus their fee, okay? So let's go over a deal breakdown example, okay? So let's do it together. You can make notes and we can practice. I should have made the numbers already, but let's do it from the very beginning. So purchase price, let's say, is 500,000. Okay. Let's say that, let's see what happens. There is some mortgage balance in here for 80,000. 80,000. And then the seller wants, look at the purchase price, 500,000. The seller wants a down payment of, let's do 200,000. Let's see what happens there. Well, the first step, what I'm doing right now is I'm going to show you, based on the first step is putting the numbers together, right? But what we're doing right now is to calculate cashback at closing for the buyer. Normally people who are buying this way, they want to buy them with no money out of their pockets or get paid at closing. So that is going to be considered a good deal on that first part of running the numbers. Remember, we have the first part, which is checking the cashback, and then the second part is performance, that I leave it for the investor to know, like, you know, how much they are going to cash flow, their exit strategy and all of that. I don't get into that much. That's what the investor needs to do. But right now we're going to calculate cashback, okay? So as you can see here, I do it at 70% LTV. So that would be 500,000 times 0.7, 350. Okay. So this means that the remaining down payment would be the remaining, which is 150. And here also I want to explain the money flow and the money source that we have. Two sources of money that comes from the Morby method. And it's also called the money available. And then we're also going to deduct the money needed, and that's how you get the cashback. I'm going to get into that. So closing costs, I like to do the numbers at 10%. Yes, it's high. But just in case, conservative numbers, I like to do that. Maybe there are agents involved. Maybe it's going to be close to 9% if there are agents involved, but I like to do it at 10%. So it would be $50,000. Then I also put in here wholesaler. I'm going to say no in this situation. So all we did right now is just put the numbers together. Really what you need to see if there is any cashback, it's only the purchase price, obviously, mortgage balance. Remember to always ask the seller or the agent if they are free and clear or not, and how much do they owe, because it affects everything: equity, seller finance portion, all of that stuff. Cash to seller, down payment. So you need the 13 is down payment. That's all. So we have the numbers. The next step for me is calculate equity. Very simple. How do we calculate equity? That is just purchase price minus mortgage balance. So purchase price is 500,000 minus mortgage balance of 80,000. We have equity remaining of 420,000. Love it. I want to tell you why this is important to know. Perfect. My next step is, now it's time to put the numbers together based on what the seller wants, okay, and see if there is if the buyer getting paid at closing. Let's see. So based on the seller wants as a down payment and the equity we have, okay. So cash to seller, we said that is $200,000. This means that the $200,000 needs to come from the equity that we have on the property, which is the 420. This means that the seller finance portion is gonna be 220. Does that make sense there? 420 minus 200,000, 220,000, that is gonna be seller finance, the remaining equity. Net money available. This is where a lot of investors get confused, and here is where I told you there are only two sources of money where we have on the Morby method, and that is from the loan amount, comes from the loan amount and seller finance. So if the loan amount is this number right here, 350K plus seller finance, which is this number, 220,000, okay, this is gonna give us what is called the net money available. Okay, so we have $570,000. Perfect. Let's put it in green. Now money needed. Okay, this is just gonna be, as you can see on the formulas, it's gonna be the purchase price plus closing cost. Let's do it at 10% and let's see what happens. So purchase price 500,000. 500K plus 50K of closing costs. It's gonna money needed $550,000. Nice. That was a tight deal, because I don't know if you're noticing something. It says money available 570, money needed 550. So cash back to buyer, yes. Net money available minus money needed, we have $20,000. What does this mean again? Whoever buys this deal gets paid at closing $20,000 to buy a piece of property. Insane, right? This is the only strategy I know where you don't have to bring an entry fee. Remember, on subject to cash deal, you gotta bring the down payment, and you either use your own money. You might not use your money, but you might need to raise capital to bring the entry fee. On the Morby method, you don't have to do any of that. So this is what the buyer would get paid. Now, this is gonna be $20,000 minus the transactional lender's fee, which depending on the transactional lender you are working with, is gonna be the $20,000 minus the transactional lender's fee, a percentage, and from the down payment plus closing cost, and then that's what you get. Now, this is also assuming two things: 10% closing costs, which are gonna be like at 5%, so it's gonna be higher amount of cashback, and LTV of 70%. Okay, so if the investor is able to get a loan to value of 75%, they are gonna get more cashback at closing, but the only downside is that they are gonna be more over leveraged. When you do the Morby method, one of the disadvantages is that you're gonna be over leveraged. Look at this. This is what the investor or the buyer is gonna owe on day one. Why? Because the loan amount is gonna be in first position right here, and seller finance in second position. Okay, that's what they are gonna owe on this property on day one. So as you can see, the purchase price originally was $500,000, and when they close, they are gonna owe $570,000. They are underwater. That's why it's really important that there are no balloon payments for the seller finance or to pay them off, and you keep this property long term. If you ever do a balloon payment, let's say 7-10 year balloon payment, always with the option to extend. Okay, always. So this is one of the downsides. So it's really important that these property cash flows, the investor is experienced on how to operate these properties. Okay, they know what they are doing. For example, I have investors that they are okay with negative cash flow for 2 years, and then after all the improvements and all of that, they are gonna cash flow, but they do it because they are experienced and they have a plan. But ideally, you want to cash flow, which is checking the performance of the property. Okay, so you can cash flow on day one or once it's 100% occupied by tenants. So yeah, this is the deal, the full deal breakdown, and how to calculate cashback. Okay, so next, how we can work together on Morby method deals. I would like to say on everything. Okay, let's go over each one of them. Run numbers and check cashback. I've been doing Zooms for 2 months now, where I jump on meetings with people, Zoom meetings, and meet investors, and they bring me deals they are working on, or maybe they tell me, hey Tonio, I want to do the Morby method on this deal. The seller is already open to seller finance. How would this look like if we do the Morby method? Happy to do that. During the week, we can jump on a Zoom. Just send me a message if you already have my contact information, or send me a DM on Instagram. Paperwork. I can help you with the paperwork. Like, for example, you can send an LOI. You as the buyer or wholesaler, you can send an LOI to the seller or agent. Once that is signed, I can help you draft the purchase and sale agreement, seller finance, and all of that stuff, and we can start working on it. So from the very beginning, I can help you. Okay, so that's paperwork. And then number 3, connect you with DSCR commercial lenders. So I already have a list of preferred lenders to work for these transactions with nice lending requirements that can be for residential, commercial, big multifamily. I already have the lenders, so you don't have to worry about that. I can connect you with the lenders that I have. Okay. Number 4, fund your deal on the transactional lending side. As I mentioned, I can fund the DSCR down payment plus closing costs. Okay. If you have a deal that you're working on and you want me to help with all of this, send me a message on Facebook, Instagram, or maybe you already have my contact information. And I'm gonna send you, we can have like a quick Zoom or call just to check what you're working on and about your deal. And then I'm gonna send you a link on my lending website where you can make the submission and I can start working on your deal. Now, that is as far as how we can work together. Anything about Morby Method, I can help you. Now, bonus, Morby Method calculator. I have a calculator that tells you I don't want to say seconds, but tells you in 1 minute cashback at closing. Like you just put the numbers and it automatically tells you like the cashback you're gonna get at closing as the buyer. So how can you get it? I mean, if this video was helpful and now it makes more sense. Still, if you are confused, happy to jump on a Zoom and explain how this works again from the very beginning, or maybe a deal that you're working on. But how can you get this calculator? Subscribe, like the video, make a comment with the word calculator, and then send me a DM on Instagram saying you want access to the calculator. So I'm gonna put a link of the calculator down below on the description. Okay, if you click on it, it's gonna ask you to send a request to have access to the calculator. So do all of this. I'm gonna check on this, and then once you do this, I'm gonna give you access to the calculator. So that is all. Hope this was helpful. If there are other investors that you know or people that want to know about the Morby Method, you can send them this video. I would appreciate that. And yeah, I look forward to doing many deals with you. So that is all, and talk soon. Bye.